What is the Federal Reserve's balance sheet? Have you ever wondered how the Federal Reserve influences the economy? One of the key tools it uses is its balance sheet. So, what exactly is the Federal Reserve's balance sheet? It is a financial statement that outlines the assets and liabilities of the Federal Reserve System, which serves as the central bank of the United States. This balance sheet is similar to what a corporation would use, but it plays a unique role in shaping monetary policy and maintaining financial stability. Let's break it down. The assets on the Federal Reserve's balance sheet primarily include United States Treasury securities, which are notes and bonds, along with agency mortgage-backed securities. These assets are crucial because they are purchased to influence interest rates and support economic activity. When the Federal Reserve buys these securities, it can expand its holdings, a process often referred to as quantitative easing. This aims to lower long-term interest rates, encouraging borrowing and investment. On the flip side, the liabilities of the Federal Reserve mainly consist of United States currency in circulation, known as Federal Reserve notes, and the reserves that commercial banks hold at the Federal Reserve. These reserves are essential for the banking system's liquidity and are influenced by the Federal Reserve's buying and selling of assets. Now, how does this all tie into monetary policy? The Federal Reserve uses its balance sheet to manage the economy by adjusting the size and composition of its assets and liabilities. For instance, during economic downturns, the Federal Reserve may increase its asset holdings to inject liquidity into the financial system. This action aims to support employment and stabilize prices. Conversely, if the Federal Reserve wants to tighten monetary conditions, it can reduce its holdings, which helps control inflation. From a bankruptcy perspective, the Federal Reserve's balance sheet plays an indirect yet important role. By influencing interest rates and credit availability, the Federal Reserve affects borrowing costs for individuals, businesses, and governments. When interest rates are lower, it can ease debt burdens, making it cheaper to service existing debts or obtain new financing. This can reduce the risk of bankruptcy. However, if the Federal Reserve tightens its monetary policy by shrinking its balance sheet or raising interest rates, borrowing costs can rise. This increase can create financial stress for borrowers, potentially leading to higher bankruptcy rates, especially for those with significant debt. Therefore, the decisions made regarding the Federal Reserve's balance sheet have substantial implications for debt management and overall financial stability. In summary, the Federal Reserve's balance sheet is a vital instrument in U.S. monetary policy. It details the assets held, primarily government securities, and its liabilities, which include currency and bank reserves. The management of this balance sheet influences interest rates and credit conditions, affecting the financial health of borrowers and the broader economy.